Topic introduces derivatives as financial contracts whose value is derived from the performance of underlying assets, rates, or indices. Common underlying variables include equities, interest rates, foreign exchange rates, commodities, and credit instruments. Derivatives are widely used for hedging, speculation, arbitrage, and portfolio management. The major categories of derivatives include forwards, futures, swaps, and options. Forward and futures contracts obligate parties to buy or sell an asset at a predetermined price in the future, while options provide the right but not the obligation to transact. Swaps involve exchanging cash flows based on different financial variables. These instruments are fundamental to modern risk management and financial market activity. The topic further explains the structure and operation of derivatives markets. Derivatives are traded either on organized exchanges or in over-the-counter (OTC) markets. Exchange-traded derivatives, such as futures and standardized options, offer greater transparency, liquidity, and reduced counterparty risk through centralized clearing systems. OTC derivatives, including many swaps and customized options, provide flexibility because contracts can be tailored to specific needs. However, OTC markets expose participants to higher counterparty credit risk due to the absence of standardized clearing arrangements. Market participants include financial institutions, corporations, hedge funds, asset managers, and governments. These markets facilitate risk transfer and price discovery across global financial systems. A key topic is the role of derivatives in risk management and financial innovation. Institutions use derivatives to hedge exposures arising from interest rate fluctuations, currency movements, commodity price changes, and credit deterioration. For example, firms can use interest rate swaps to convert fixed-rate liabilities into floating-rate obligations or vice versa. Currency derivatives help multinational corporations manage foreign exchange risk associated with international trade and investment. Although derivatives improve efficiency and flexibility, they may also introduce leverage and complexity into financial systems. Improper use of derivatives or inadequate risk controls can lead to substantial losses and contribute to systemic financial instability during periods of market stress. Topic also focuses on central clearing and its role in reducing counterparty credit risk within derivatives markets. Central counterparties, CCPs, act as intermediaries between buyers and sellers, becoming the legal counterparty to both sides of a transaction. This process reduces bilateral credit exposures because market participants no longer rely solely on the solvency of individual counterparties. Central clearing also enhances transparency, standardization, and operational efficiency within financial markets. Following the global financial crisis, regulators encouraged mandatory clearing for many standardized OTC derivatives to reduce systemic risk. CCPs require margin deposits, collateral management, and daily settlement processes to ensure the stability and integrity of cleared transactions. The topic also discusses the modeling and management of derivative-related risks. Derivative contracts expose institutions to market risk, counterparty credit risk, liquidity risk, and operational risk. Risk models are used to estimate changes in contract values under different market conditions and evaluate potential future exposures. Value at risk, VAR, stress testing, and scenario analysis are commonly applied to measure potential losses arising from adverse market movements. Counterparty credit risk models estimate the likelihood and impact of default by trading partners. Institutions also calculate credit valuation adjustment, CVA, to incorporate counterparty risk into derivative pricing. Accurate modeling is essential because derivative exposures can change rapidly with market volatility and leverage effects. Finally, topics emphasize the growing importance of derivatives and central clearing mechanisms in global financial markets. Derivatives provide essential tools for transferring and managing risk, supporting investment strategies, and improving market efficiency. However, the complexity and interconnectedness of derivative markets can amplify systemic vulnerabilities if risks are poorly managed. Central clearing has strengthened market resilience by reducing bilateral exposures and increasing transparency, though it also concentrates risk within clearinghouses themselves. Effective derivatives risk management therefore requires robust governance, collateral practices, quantitative modeling, stress testing, and regulatory oversight. These measures help financial institutions manage evolving market risks while maintaining financial system stability.